In today's world, more and more people are waking up to the importance of investing. But awareness alone doesn't guarantee action. All too often, this knowledge never translates into steps forward, held back by confusion, a lack of direction, or the fear of making costly mistakes. The result? Many remain stuck at square one, never making that first move toward building real wealth. But imagine having a mentor, someone who could demystify the complex world of finance, break it into simple, digestible insights, and give you the confidence to invest with purpose. Wouldn't that change everything? Well, today's book summary might just be that guiding voice. Welcome to Books Reader, where we don't just summarize books, we bring them to life. Each book here is a stepping stone toward a better, smarter version of yourself. And today, we're diving into the essays of Warren Buffett, Lessons for Corporate America, a timeless collection of insights compiled and edited by Lawrence Cunningham. This book gathers Buffett's iconic letters to Berkshire Hathaway's shareholders, letters that go far beyond routine financial updates. They're packed with personal reflections, practical advice, and candid stories from one of the greatest investors of all time. These aren't just casual musings, they're lessons drawn from decades of experience in investment strategy, corporate governance, taxation, accounting, mergers and acquisitions, and more. If you've ever wanted to get inside the mind of a billionaire investor and business thinker, this book offers that rare opportunity. Thanks to Cunningham's thoughtful organization, these essays are not only educational but also engaging and accessible, even if you're new to the world of investing. So let's dive in and explore the timeless lessons that continue to shape the world of finance. Corporate governance. Warren Buffett doesn't just invest money, he also builds companies. In his letters, he shares the core principles that guide the way Berkshire Hathaway operates, starting with transparency, accountability, and shareholder respect. Buffett points out a stark contrast between Berkshire's annual shareholder meetings and those of many other corporations. According to him, most corporate meetings have become shallow and ineffective. Instead of meaningful financial dialogue, they're often sidetracked by irrelevant concerns and lack substance. The result? Business-minded individuals tend to skip them altogether. In contrast, Berkshire Hathaway's annual meetings are unique. They offer open, honest, and detailed discussions. Buffett and his longtime business partner, Charlie Munger, answer every single question, no matter how long it takes. Their mission is to ensure shareholders walk away with clear, accurate, and useful information. Buffett emphasizes that if he were a shareholder, he'd expect nothing less than complete transparency, and that's exactly what he delivers. One of his strongest beliefs is that honest communication is non-negotiable. Investors deserve a true picture of a company's financial health. Without this openness, it's impossible to make informed decisions. Buffett is also critical of unclear or overly complex accounting practices, which he sees as warning signs. When companies use convoluted financial methods, it often suggests that management is trying to hide something. At Berkshire, clear and straightforward financial communication is the norm, because that's what builds trust. He warns that many corporations only highlight the data that makes them look good, conveniently ignoring the less flattering details. This selective presentation creates an illusion of strength, which is not just misleading, it's dangerous. Another red flag? Unrealistic promises from CEOs. Buffett cautions investors to be skeptical when a company claims it will grow at, say, 15% per year indefinitely. These kinds of projections may sound confident, but they're often unrealistic. Instead, investors should look for companies that use sound accounting methods and offer conservative, data-driven forecasts. Buffett also encourages readers to pay close attention to the footnotes in financial statements. If they're overly complicated or vague, it's often intentional. It may be a deliberate attempt to hide information that leadership doesn't want shareholders to fully understand. He's also outspoken about CEO accountability, or the lack thereof. In most jobs, performance is clearly measured. For example, a secretary needs to meet a typing speed requirement. But CEOs often operate without any measurable standards or direct oversight. This lack of structure allows underperforming leaders to stay in power far longer than they should. Another issue he highlights is how charitable contributions are handled. In many companies, executives and directors decide where charitable donations go, without consulting the shareholders. Buffett finds this practice troubling. Imagine if shareholders could dip into the pockets of directors and decide how their money should be spent. It wouldn't fly. He believes donations should align with the company's purpose first, and any discretionary giving should reflect the preferences of shareholders, not executives. Ultimately, Buffett envisions a system where managers are trusted stewards, but the final authority rests with the owners. That's the model Berkshire follows. When it comes to risk control, Buffett makes one thing very clear: it is the CEO's personal responsibility. Delegating it or ignoring it isn't an option. The person at the top must be the first to understand and manage the risks involved. If a CEO refuses to take ownership of risk management, they simply don't deserve the role. As Warren Buffett puts it, we can afford to lose money, but we can't afford to lose our reputation. That single principle is the foundation of Berkshire Hathaway's approach to risk. Of course, no CEO can monitor the behavior of every employee, especially in a company like Berkshire, which employs over 250,000 people. Mistakes are inevitable. What truly matters is how leadership responds when issues arise. Buffett's approach is direct and immediate: act quickly and decisively the moment a problem is discovered. Finance and investing. In this section, Buffett outlines his long-term investment philosophy. Rather than trying to predict market movements or chase short-term gains, he focuses squarely on the underlying business. For him, success lies in understanding a company's long-term economic potential, not in timing the market. Whenever Buffett buys a stock for Berkshire Hathaway, it's with a long view in mind. Market volatility doesn't concern him. Even short-term losses don't bother him, as long as he believes in the company's future. His goal is simple: invest in businesses that can generate sustainable, long-term value. Buffett emphasizes that he's not a market analyst, he's a business analyst. He doesn't follow trends or technical signals. Instead, he invests only when he's confident a business will provide solid returns over time. To illustrate this, Buffett introduces a character called Mr. Market. This metaphor represents the stock market as an emotional, often irrational person, one day wildly optimistic, the next deeply pessimistic. But the beauty of Mr. Market is that he doesn't care if you ignore him. He'll come back tomorrow with a new offer. This teaches investors to resist emotional reactions to market swings and instead focus on value. Buffett explains that when stock prices drop, most short-term investors panic. But he compares this to someone who loves hamburgers. Would they be happier if beef prices went up or down? Naturally, they'd prefer lower prices. Similarly, a smart investor should welcome declining stock prices if the underlying business is strong. That's when value emerges. When solid opportunities are scarce, Buffett turns to arbitrage, a strategy of buying in one market and selling in another to exploit price differences. Even slight discrepancies, like between currencies or commodities, can lead to meaningful profits. For example, if gold prices fall in Japan but remain high in New York, a sharp investor could buy in one market and sell in the other. Buffett discourages sticking to a rigid investment style. Instead, he advises investors to stay flexible, think independently, and make decisions based on thorough research. His golden rule: find great businesses at reasonable prices, don't settle for average businesses just because they seem cheap. He's also not a fan of diversification for its own sake. While spreading investments can reduce risk, Buffett sees many investors diversifying without truly understanding what they're buying. He prefers to invest only in businesses he understands well and believes in, especially those led by trustworthy management. Many people rely on a stock's beta, a statistical measure of its volatility, as a guide for risk. A beta of 1.5 suggests the stock is 50% more volatile than the overall market. But Buffett sees this as a flawed approach. A stock's true value isn't revealed by its beta. Instead, success comes from deep analysis of a business's fundamentals. His advice is clear: don't invest based on beta, trends, or speculation. Invest in what you understand. Avoid being influenced by market noise. Your success as an investor depends on making well-researched, independent decisions. Investment alternatives. Here, Buffett examines three broad types of investments, comparing their risks and potential returns. He also critiques the rise of junk bonds and airline stocks, and shares his views on share buybacks and why future investment returns might not be as high as in the past. The first category is currency-based investments, such as bonds, mortgages, and savings accounts. These are often seen as safe, but Buffett warns against being misled. While these investments may preserve your principal, they're highly vulnerable to inflation. Over time, inflation erodes the purchasing power of money, making your returns effectively smaller. Governments control monetary policy, and inflation can quietly eat away at your wealth, often without obvious signs. Though higher interest rates might sometimes compensate for this, it's rare. That's why Buffett doesn't favor currency-based investments. They appear stable, but in the long run, they can diminish your net worth. The second category of investments includes assets that don't generate income on their own but are purchased with the hope that their price will rise over time. A classic example is gold. Gold doesn't produce anything, it just sits there. It doesn't create value, it doesn't pay dividends, and it doesn't generate cash flow. Its demand is limited, yet many people buy it speculatively, hoping someone else will pay more for it in the future. To Buffett, this kind of investing lacks substance and is rooted in speculation, not intrinsic value. In contrast, the third category, and Buffett's personal favorite, consists of productive assets. These include businesses, farms, and real estate. What sets them apart is their ability to generate income and build value over time. With a relatively small initial investment, these assets can offer substantial long-term returns. After carefully comparing the three categories, Buffett concludes that productive assets consistently outperform both currency-based investments and non-productive assets like gold. Still, not all investors see it this way. Buffett points out the persistent popularity of junk bonds, high-yield bonds issued by borrowers with low credit ratings. On the surface, these may offer attractive returns, but they carry significant risk. A poor credit rating signals that lenders have had trouble recovering funds from these borrowers in the past. To lure investors, such institutions offer higher interest rates, but those returns come with a higher chance of default and often lead to major losses. Buffett recalls the surge in junk bond popularity during the 1980s. Many investors, drawn in by the promise of high returns, ultimately suffered heavy losses. He also shares a humorous anecdote. When Richard Branson, founder of Virgin Airlines, was asked how to become a millionaire, he quipped, "Start as a billionaire and then buy an airline." That's how precarious the airline industry can be. Buffett himself once invested in an airline, a decision he later regretted. Although the company's financial statements looked sound, he underestimated the industry's cutthroat competition. Even strong financials can't guarantee success in a hyper-competitive market where profit margins are razor-thin. This experience underscored a valuable lesson: even well-researched investments can go wrong if industry dynamics are overlooked. From that, Buffett emphasizes a timeless principle: be fearful when others are greedy, and greedy when others are fearful. When investor enthusiasm is at its peak, it may be time to pause. Conversely, when others are hesitant and fearful, opportunities often emerge. This logic may seem counterintuitive, especially when U.S. businesses appear to be thriving while investment returns are declining. Why is this happening? Buffett explains it through a simple analogy. Imagine a family that owns every American company. Over time, they become immensely wealthy from their ownership. But eventually, consultants and advisors arrive, offering to help, for a fee. Gradually, more layers of management and services are added, each one siphoning off part of the family's wealth. Not because the businesses themselves are less profitable, but because the costs of outsourcing and professional management slowly erode returns. This is what happens when investors hand over control to private equity firms and hedge funds. These intermediaries charge high fees that eat into profits, even when the underlying businesses perform well. As a result, investors holding strong assets still receive lower net returns because so much is spent on management expenses. At Berkshire Hathaway, Buffett and Munger strive to avoid this trap. They follow two key principles. Never overstate the value of the company. they aim for transparency and authenticity in financial reporting. Build lasting relationships with shareholders. They prefer long-term investors who understand and support the company's philosophy. Buffett likens a constantly changing shareholder base to a school or church where people are always coming and going. It disrupts the sense of community and shared mission. He values consistency and trust over frequent turnover. He also discusses share repurchasing, a practice where companies buy back their own stock. This usually signals that leadership believes the stock is undervalued. Buffett agrees that share repurchases can be a positive indicator, but only if the stock is trading below its intrinsic value. Although there were times he believes he should have repurchased shares, he sticks to a disciplined rule: never buy back stock unless it's priced meaningfully below its true worth. Mergers and acquisitions. In this chapter, Buffett delves into his approach to mergers and acquisitions, emphasizing the importance of understanding intrinsic value over surface-level metrics. He describes acquiring great businesses as one of his favorite activities, comparing it to finding a life partner. The process requires patience, discernment, and genuine interest. If you rush it, you risk making a decision you'll regret. Just as a hasty marriage can lead to heartache, an impulsive acquisition can be financially damaging. In his early career, Buffett admits he sometimes bought companies based on how good they looked on paper, without fully understanding the underlying business. Over time, he refined his approach, focusing only on fundamentally sound companies, even if the market hadn't yet recognized their value. For Buffett, long-term commitment is essential. He avoids short-term deals and quick flips. When Berkshire acquires a company, it's not just buying assets, it's building a partnership. He wants to invest in businesses with solid leadership, strong values, and enduring potential. When Warren Buffett decides to acquire a company, it's always with a long-term relationship in mind. His approach to mergers is guided by a simple but strict principle: he won't issue Berkshire Hathaway shares unless what he's receiving in return offers equal or greater intrinsic value. To illustrate this, he asks a pointed question: why would anyone trade $5 for 5 cents? The message is clear: a merger only makes sense when the value gained equals or exceeds the value given up. He also addresses leveraged buyouts, LBOs, acquisitions funded primarily with borrowed money. Buffett offers a witty but telling analogy. Imagine a man takes his lame horse to the vet and says, "Sometimes it walks fine, sometimes it limps." The vet responds, "Then sell it while it's walking fine." This is how some corporations operate. They offload their businesses while they still look healthy, concealing deeper issues from potential buyers. To guard against these traps, Buffett insists on one key condition before acquiring a business: the current owner must stay on as a manager. He looks for owners who built their companies with care, passion, and integrity, people who aren't just selling for a profit, but who genuinely care about the company's legacy. This long-term stewardship aligns perfectly with Buffett's own philosophy. Understanding intrinsic value. Buffett places heavy emphasis on understanding accounting figures. While many investors shy away from financial statements, he believes that examining them closely is essential. A central concept here is intrinsic value, the estimated worth of a business's assets and earnings, independent of future uncertainties. It's not an exact number, but a reasoned approximation. And if two rational investors review the same data, their estimates of intrinsic value will often be close. Interestingly, Berkshire Hathaway doesn't report intrinsic value directly. Instead, the company provides all the raw financial data so shareholders can calculate it for themselves. While they do include book value per share, Buffett warns this figure is limited in usefulness. Book value simply measures total assets minus liabilities, divided by the number of shares. But this doesn't always reflect real economic value. In many cases, book value and intrinsic value can diverge significantly. Buffett explains that Berkshire's case is a bit unique. Its steady earnings and low debt make estimating intrinsic value easier than it would be for most other companies. This clarity is one of the reasons shareholders trust the long-term vision of the business. But even accurate accounting can be deceiving. So how does one assess real value? Buffett's answer: focus on earnings. Look at current profits and evaluate how they might realistically grow in the future. It's not about reacting to the latest annual report, it's about understanding the long-term direction of the business. He briefly discusses the Black-Scholes model, a formula widely taught in business schools to calculate the fair value of options. While it can produce questionable results when stretched over long periods, Buffett and Munger still include it in their reports. Why? Because it's the standard. Leaving it out might raise doubts about their transparency, even if the model itself isn't perfect. Accounting shenanigans. In this chapter, Buffett turns his focus to a less glamorous, but critically important, topic: accounting manipulation. He warns investors to stay sharp, because not all financial reports are as honest as they appear. No matter the accounting method used, Buffett says every investor should ask 3 essential questions. What is the true value of the business? Can it meet its future obligations? How competent and trustworthy is the management? While most companies follow generally accepted accounting principles, GAAP, to standardize their reporting, Buffett warns that GAAP compliance doesn't guarantee clarity or truth. In fact, some companies cleverly use GAAP to obscure reality. One common tactic is manipulating net income, a metric heavily watched by investors. Buffett notes that even he and Munger could legally adjust Berkshire's net income to reflect almost any number, simply by altering a few variables. For instance, net income includes realized gains but ignores unrealized ones, allowing for selective presentation. Though Berkshire refrains from such manipulation, many other corporations do not. Another trick? Restructuring charges. These are supposed to be one-time costs incurred during a business reorganization. But some companies abuse them by bundling years of poor performance into a single charge. This lets them paint a cleaner picture going forward, creating the illusion of steady improvement. Buffett uses a clever analogy. Imagine a golfer who usually scores around 80. One day, he has a terrible round and scores 140. To reset his image, he gets golf lessons, restructuring, then returns with slightly worse than average but more consistent scores, 91, 94, 89, and 92. To outsiders, it looks like he improved, when really, he just buried the disaster. Similarly, companies might mask years of losses with one restructuring charge and follow up with slightly better results, misleading investors into thinking there's true improvement. Buffett also discusses the accounting treatment of acquisitions. There are 2 main methods. Purchase accounting: assets and liabilities are recorded at fair market value. Pooling of interests: assets and liabilities are recorded at original book value. However, the Financial Accounting Standards Board, FASB, has since banned pooling of interests because it was too easily abused. Finally, Buffett mentions improvements in GAAP that now require companies to report detailed segment data, particularly for subsidiaries. This allows investors to better understand the performance of individual components within large companies, rather than relying solely on consolidated results. In the past, companies could summarize their entire operations with a single figure on their financial statements. Today, reporting standards have evolved, requiring businesses to break down their obligations, including tax liabilities and long-term commitments like pensions. This shift has fundamentally changed how balance sheets are calculated and interpreted. While this evolution has improved transparency in theory, it has also added complexity to financial reporting, making it easier for less ethical companies to manipulate figures and mislead investors. This is precisely why Warren Buffett stresses the importance of investor education in accounting practices. Understanding what's beneath the surface allows you to pierce the illusion and make smarter, safer decisions. Tax matters. In this chapter, Buffett explores the impact of tax reforms on both corporations and consumers, reflecting especially on the 1986 Tax Reform Act. While the act introduced several praiseworthy changes, Buffett notes that the overall effect on Berkshire Hathaway was more negative than positive. One of the key shifts was the change in shareholder returns. Where previously $1 of profit would leave 80 cents after tax, the new law meant only 72 cents remained, as the effective tax rate increased from 20% to 28%. At first glance, Berkshire's corporate tax rate on ordinary income, dropping from 46% to 34%, might seem beneficial. But the broader implications weren't entirely favorable, particularly for long-term investors. There's often debate about who really pays corporate taxes, the business or the consumer. Buffett's answer is nuanced. It depends. Sometimes, lower corporate taxes lead to direct shareholder gains with minimal consumer impact. Other times, companies pass tax costs onto customers through higher prices. The outcome hinges on two factors: how powerful the business is, and whether the industry is regulated. In regulated sectors, such as utilities, tax savings are usually passed along to consumers via reduced prices. However, in unregulated markets, tax cuts more often benefit shareholders and management. Buffett offers a vivid analogy. If the only brain surgeon in town receives a tax cut, do you expect the cost of brain surgery to drop by 50%? Of course not. Similarly, just because taxes fall doesn't mean savings are passed on. They often just increase the owner's profits. Another notable change Buffett highlights is the increase in the capital gains tax, from 28% to 34%. Capital gains, profits from the sale of long-held investments, are central to Berkshire's strategy. Buffett points to three long-term holdings: Capital Cities, Geico, and the Washington Post. Despite a combined market value of approximately $1.7 billion, they yielded only about $9 million annually at the time. Clearly, Berkshire wasn't investing for immediate income, but for long-term value appreciation. Higher taxes on those gains directly reduced overall returns by up to 10%. Yet, Buffett and Charlie Munger don't complain. Instead, they focus on long-term value and use smart tax planning to navigate the system. In fact, rather than acquiring small positions, they prefer to buy entire companies whenever possible. Full ownership, under favorable tax laws, often proves more profitable than holding minority shares. For Buffett, more taxes simply mean more success. Higher tax bills are a sign that the business is thriving, and that's a trade-off he's perfectly willing to accept. Conclusion: this collection of Warren Buffett's letters to shareholders is more than a historical archive. It's a masterclass in finance and investing, distilled into practical lessons and timeless wisdom. Each letter reflects the real-world experience of one of history's most successful investors. Buffett doesn't merely theorize. He shares first-hand insight into how financial decisions are made, covering everything from mergers and acquisitions to tax strategy, financial reporting, and corporate governance. What makes this collection truly exceptional is its structure. Curated and edited by Lawrence Cunningham, the essays are arranged thematically, making Buffett's philosophy easy to understand and build upon. Whether you're a beginner or a seasoned investor, these writings offer value at every stage. This book doesn't just inform, it mentors. Once you've absorbed these principles, you won't just read financial statements differently. You'll see the investment world with greater clarity, confidence, and critical thinking, just as Warren Buffett intended.